Hi, and good afternoon from a sunny but cold Hyde Park. Thank you all for joining us, including the students at the watch party here on campus at the Harper Center. My name is Chris Weed. I'm Executive Director of the Stigler Center for the Study of the Economy and the State at the University of Chicago Booth School of Business. Today, we're happy to host a conversation on ESG in partnership with our colleagues at the Rustandy Center for Social Innovation. Our speakers today are Elizabeth McEvern, David Swift, Luigi Zingales, and Marianne Bertrand will be moderating the conversation. For those of you who are interacting with the Rustandy Center for the first time, the center is the social impact hub for Chicago Booth for people committed to tackling complex social and environmental problems. The center promotes innovation, advances research, and develops the people and practices that can accelerate social change. And for those of you who aren't familiar with the Stigler Center, the center is dedicated to understanding the issues at the intersection of politics and the economy. Through research support and a range of courses, events, and initiatives, the center has become an intellectual destination for research on regulatory capture, crony capitalism, and the various forms of subversion of competition by special interest groups. This is the second installment of our Unpacking ESG series in collaboration with the Rustandy Center. The series was created to investigate the ways in which ESG is or is not being used as a force for positive impact. The first event provided a more general overview of the ESG landscape, while this one focuses on the issues and trade-offs investors are facing when choosing between divesting from companies, i.e. exit, or changing them from the inside, i.e. voice. Before we begin, please note that we are on the record. We will post this video to our YouTube channel later. If you have questions for the speakers, we will address them in the last few minutes. You can submit them via the Q&A icon at the bottom of your screen. As usual, the views expressed by guests here are their own, not those of the Stigler or Rustandy Centers or the University of Chicago. We hope that you'll join us for more upcoming events and webinars. Please check out our websites for more details, as well as the Stigler Center's publication, promarket.org, and our Capitalism podcast. The relevant links can be seen in the chat function at the bottom of your screen. Now, let me please briefly introduce our speakers. Elizabeth McEvern is the Director of Investments at the McKnight Foundation, a Minnesota-based family foundation that supports advancements towards a more just, creative, and abundant future. David Swift is a Chief Operating Officer at EngineOne, an investment firm that focuses on long-term value. As they put it, aims to bring common sense back to capitalism. Luigi Zingales is a Robert C. McCormick Distinguished Service Professor of Entrepreneurship and Finance at Chicago Booth. He is also a George Rendier Faculty Fellow and Faculty Director of the Stigler Center. And last but not least, our moderator today is Marianne Bertrand, who's the Chris P. Downes Distinguished Service Professor of Economics at Booth. She is also Faculty Director for the Rustandy Center for the Social Sector Innovation. And now, without further ado, let me turn it over to Marianne.
Great, thank you so much for the introduction, Chris, and thanks for everybody for joining us. Maybe in order to get the conversation started, start with Luigi. I mean, Luigi, you've been doing a lot of thinking, a lot of writing academically on the questions of exit versus voice. Can you help us, kind of frame the conversation, in light of your work, contrasting kind of these investment strategies for, kind of a shareholder that's trying to be socially responsible versus exerting voice? What exactly are we talking about, Luigi?
So, Marianne, thank you very much. And thank you, everybody, for the invitation in such a great panel. So we're all here because there is enormous interest in ESG as investors, as workers, as consumers. But as academics, as you said, we are in the business of classifying things. So let me try with a couple of classifications that hopefully help steer the conversation in the right direction. So first of all, I want to distinguish the various reasons why investors, and to some extent this can be applied to consumers and workers as well, but let's start with investors, are interested in ESG, because I think there are three main reasons, which are not mutually exclusive. So there might be a combination of the above, but I think it's useful to keep them separate. And one is people love ESG because it's a good predictor of long-term stock return. And you can tell that a lot of reasons why this might be the case, because it's a sign of good management, because it's a sign that non-sustainable businesses sooner or later will not be sustained, and so they will lose in value, or because you expect that regulation will eventually penalize businesses that are non-sustainable. However, the reason is irrelevant, more or less. It's simply a directional bet that you like to make it. Like in a time where you expect inflation, you want to bet on gold, and in a late phase of the business cycle, you might want to bet on consumer good rather than on investment good or whatever. So there is no moral dimension to it. And the fact that this bet might or might not have positive collateral effects on the planet is not a decisive factor, but is maybe just icing on the cake. Then there is a deontological stance. I hope I get it right, and if not, please correct me because I'm not an expert in religion. But if you're a Mormon, you don't want to make money by producing wine. And as far as I understand the Mormon religion, you don't necessarily want to prevent other people to make wine, nor do you mind that other people make money by producing wine. It's just you don't want to involve with it. Or more recently, after the invasion of Ukraine by Russia, several people I've seen and heard have taken the deontological stand. You don't want blood on your hands, so you don't want companies to that you invest in, or you work in, or you buy from, to have any dealing with Russia. Now, what is interesting is that many of these people take a moral stand in the sense that they don't even look at the ultimate effect of what happens. It's possible that divesting from Russia may make Russians or even Putin richer, or might make Putin's grip on power stronger. So, for example, think about Wikipedia. If Wikipedia decides to get out of Russia, Russians get less information. And Wikipedia now is not a for-profit, so they not make money, but you can see the argument. And then third, there is what I call a consequentialist approach. And I have some goal. I want to improve the environment, help Ukraine, promote diversity, you name it. And my motivation might be moral, to punish Russia responsible for invasion, or simply practical. I want to preserve a livable world for me and my children and great-grandchildren. But I'm not satisfied with the moral action per se. I care about the consequences of my action. So I don't want to give an impression that one reason is better than another. So as an economist, I treat preference as a given. And this distinction has to do with preferences. So nevertheless, I think it's important to ask ourselves what drives our ESG interest. Now, having classified the motivation, let me now move to the strategies. There are two main strategies that, following Albert Ishman, I will call exit and voice. Exit means divestment if you're an investor, boycotting if you're a consumer or a worker. The alternative is voice. If you're an investor, voice means voting at shareholders meeting or engaging with management to make a change. If you're a worker, voice might mean negotiating with management for a change. If you're a consumer, the voice option is a little bit more limited. So I'm not so sure that as an analogy. Now, the two strategies tend to be substitutes. On the one hand, if a fraction of pro-social investors chooses to divest rather than engage, the chances to gain a majority at any shareholders meeting on issues that are pro-social is shrinking. On the other hand, if a fraction of pro-social investors try to engage, they will ultimately undermine the effect of divestment, because to engage you have to have votes, and to have votes you have to have ownership, so you shouldn't divest. So there is an important trade-off here, because if you are pro-social investors, you need to coordinate on one strategy versus the other. So the question I want to leave the panel with, and of course I will participate, but I want the practitioners to get in, is clearly the first two motives are very happily satisfied by exit, not necessarily the consequential approach. The consequential approach, in my view, leads more to justify a voice, However, as I said, there is a trade-off. There is a risk that by going one direction, you undermine the other. So I would like to have the opinion of the people who do that for a living. How do they see, number one, their motivations, and number two, their strategies, and how the two are coherent?
Great. Thank you so much, Luigi, for kind of framing the conversation so well. David, you represent EngineOne, who's made a splash last year for kind of forcing some changes on the board of Exxon. I have a broad sense of your strategy, kind of going back to Luigi's framework, which is one of more of a voice one. I don't have a good sense of your motivation. So can you tell us a bit more about EngineOne, kind of how you describe what you do, and to the extent that it's possible, link that to the nice framework that Luigi has introduced for us. Thanks, David.
Sure, happy to do that, and thank you for having me as part of the panel. Luigi's work was something that inspired us, honestly, to create an investment framework that would push for change. Now we're firmly in the voice camp, as you might have guessed, doing the work that we did with ExxonMobil and some of the work that we're doing with companies that we own in our various investment strategies. We started the organization, EngineOne, with a simple idea that if we're going to really be driving the type of change and impact that we want to have as investors, as capitalists, we would need to do that at scale in the public markets to really have the amount of change and sort of the flywheel of change that we were looking for. And we looked at the existing ESG landscape before starting EngineOne, and we're wildly unsatisfied with a number of the approaches and investment strategies that were available. Most of them do sit in that divestment camp. They use varying data sources to screen out the quote unquote bad companies and give you a portfolio of good companies. And I use those in quotes because what is the determining factor for good and bad is a little non-correlated. But what you end up with in most cases are climate-friendly tech businesses that have low carbon footprints, and that's the portfolio that you're buying, which is fine, but it's not going to inspire the type of change and impact that we really need to see out of the industries that are producing a lot of the carbon or the environmental damage, the social damage that need to change. And so we took a very different tact. The first was to create a framework inspired by some of the work that Luigi and his colleagues have done to quantify both the material impact that a business has and sort of net it against the profitability of the business. And we call that our total value framework. So we look at how a company generates its profits, and then what type of damage, either environmental or social, it does in dollar terms to get to that profitability. And we look for outliers. Exxon was an extreme outlier in the energy space. They certainly do generate a lot of profit, but along the way they do a lot of damage. And we were able to quantify that in different ways in dollar terms. And so if we can go in, engage with that organization and that management team to think about a path to reduce the damage, that should be a net positive, both for the company and its future profitability, but for the environment and the world. And so that's what we intended to do with the Exxon campaign, and one of the reasons that we ran the campaign that we did. But the broader idea is to continue to work with the management teams of organizations, hopefully in a collaborative way. I mean, that's really the best way to drive the positive outcomes that we're going for, to reduce the externalities that these companies have over time, with strategies that make their businesses more durable. So now I'm going to tie it back to the framework that he laid out in the beginning of the discussion. So we do sit in the, ESG is a good predictor of long-term economic outcomes. That's our camp. There are ideological reasons to pursue these paths, certainly. But for us, I think for us to have an argument across the different constituents that we need to sit in the good predictor of long-term returns and make economic arguments around these strategic changes that companies need to put in place, so that we bring all different types of stakeholders to the table to support these initiatives. And so you don't get mired in an ideological battle. These are about economic outcomes. Now, our framework doesn't work for every instance, and he actually brought up Russia. That's a country, not a company. It doesn't have the governance structure that a US listed public company does. And so there are limitations to what we can do, but there are a lot of opportunities in the United States and globally to engage with organizations to drive change. So I'll take a pause there. Hopefully I brought it all back and can answer questions.
That's great. Can I just one quick follow-up question, David? So you said the framework is that you view ESG as a good predictor of longer term outcomes. Is that, I think this is a place where, kind of I might disagree. I would tend to think that there is actually a trade-off between, internalizing some of these externalities, the social stuff and the bottom line. You're not taking that position. Is that, kind of because you think it's important in terms of attracting, investors? Why are you taking that position?
Well, so the trade-off argument is a common one. And I think the short answer to your question, the argument that some allocators may have is that the trade-off is really relative to your duration of investment, right? So over a short period of time, companies will have to internalize some of these damages, and those are inflationary. And so they will, over a short period of time, perhaps, have suboptimal economic outcomes. However, over an extended duration, and the duration is different for every company, these economic outcomes actually should be positive. And so, our argument is that over time, if a company is on the right side of a business transformation, like the energy transformation, or in the case where we're very publicly working with GM as it evolves towards battery electric vehicles, if they find themselves on the right side of that transformation, the short-term investments they need to make should prove to pay off in multitudes over the long term. And so, you think about that business that GM is a prime example. Over the course of time, if they get this right, they have the ability to take market share from other auto manufacturers. They have the ability to recruit and retain better employees. They have the ability, if they execute on that, to innovate internally versus facing technological innovative pressure externally from their business. And they should see continued support from investors and capital allocators, so that all those macro tailwinds for that business should be a result of them, making short-term investments to increase the durability of their business over the long term. And we would expect the business to experience better growth rates. And as market participants, we also expect that to come with better multiples, so multiple expansion in that business as well. And so the answer is we don't think there are trade-offs if you extend duration long enough.
Thank you so much. Elizabeth, you are here kind of representing a foundation, but a foundation that has made a commitment to be kind of carbon neutral in all of its, investments, the investment of its endowments. So can you tell us a little bit about your approach to that? Again, kind of keeping the same framework, kind of motivation for doing that, and also strategically, how you achieving that, maybe balancing kind of exit strategies versus voice strategies. Thanks.
Great. Well, I'm from the McKnight Foundation. One of our largest grant-making programs is called the Midwest Climate and Energy Program, because the Midwest is the largest region that produces greenhouse gas. And if the Midwest was a country, we would be the 6th largest producer of greenhouse gases in the world. So the US can't win on climate unless the Midwest wins on climate. So that is one of our main grant-making areas. What's great about that is this is a area that's really swimming with markets. So a lot of the opportunity we see related to the energy transition is with markets versus trying to swim against markets, such as trying to preserve affordable housing. So we're fortunate in that respect. But it's our view that with 5% of our endowment that we have to provide in grants every year, the other 95% of the endowment needs to be also working for better markets. And by better, I mean more sustainable, long-term, transparent. So we use that 95% of our endowment, which is about a $3 billion foundation, with these kinds of goals in mind. So I think to speak to Luigi's framework, we are most certainly, and with David, in the predictor of long-term stock performance camp, both stock and for our private investments. We really very much see, we are an absolute return investor. We're not liability driven like a pension fund. We have to produce 5% of our endowment every year, but we don't have to pay people's retirements. So we have the luxury of having a 20-year horizon. And we're pretty confident in our theory that over the long term, being attentive to these pressing economic issues are going to be valuable for the endowment. I'd also say that we're a consequentialist investor, as you described it, Luigi. We very much are using our money in different ways and very purposefully to build an economy that takes care of externalities, to build an economy where companies are not incentivized by investors to always operate in 1 and 2 year horizons for capital investment and other behaviors. So those are kind of I would say, the two main motivations. We think that although our $3 billion is very small in the context of markets, we know that that we are one of many investors who are trying to work in this direction, and increasingly asset owners are very interested in this type of behavior. So as for strategies, exit versus voice, I'm gonna add a third category. So I'm going to add exit, voice, and also select better. So I would say we participate in all 3 of these areas at McKnight Foundation. So in terms of exiting, in 2014, we introduced 10% of our endowment for impact investments, which are market rate investments. But at that time, we very decidedly decided not to divest. We kind of thought it would be a big wrestle. It was an ideological question that was a big thing to get to the ground. So instead, we decided that we would decarbonize our portfolio, and we've been actively decarbonizing the portfolio since that time, which leads us to 2021, where we became the largest foundation in the US to make a net zero endowment commitment. Many institutional investors and other actors have made this commitment, but the foundation community as asset owners has been relatively slow. That will require us to divest from fossil fuels and also decarbonize. We certainly use our voice, particularly with our fund managers as a customer of financial services, which I'm happy to talk about later. But I think for us at our size, that's actually a place we can have greater impact with our managers rather than with the end holdings in the portfolios. And then select better to me is you don't need to exit and you don't need to use your voice if you're investing in companies that are aligned with your views of the future and your views of opportunity in the first place. And so a large portion of our endowment is already aligned with our long-term thesis about the future of the economy. So exit, voice, and select better, both fund managers and investment options.
Good. On the exit side, which is like definitely one of the 3 strategies that you are, that you're using, the common kind of reaction to exit, I think that fits someone into Luigi's framework is the idea that it's better to have people that quote unquote care, to be kind of holding the assets than having, the Koch brothers or whatever is left, the half of the Koch brothers that's being left, kind of being the investors in, oil and gas, for example. So what is your reaction to that? How do you think about, the exit strategy in light of that, that reaction?
Yeah, this has been an ongoing conversation for 20 years around climate and divesting from fossil fuels. I don't particularly think divestment, theoretically, it's a cost of capital strategy, but not really. I think the work that David and EngineOne and so many longstanding institutional investors have done for so many years is much more around strategy and risk mitigation than it is around reducing the cost of capital. So I also think that there are far more large institutional investors that are developing very comprehensive voice strategies around their own voice and different expectations from what they expect from a publicly traded company. So it's perfectly okay for McKnight to take our we're already very underweight oil and gas already. So it's okay for us to take ourselves out of that exposure, but we know that, BlackRock has taken a number of steps over the last couple of years to kind of ramp up its pro-climate shareholder voting. So EngineOne really benefited from being able to pull all of these investors before that were not necessarily as engaged as they are today. So when they heard a good proposition from EngineOne, they actually had the engagement structure internally to vote for those proposals they filed and to support that kind of strategic viewpoint. I don't know, David, do you have thoughts on that? I mean, really, this is your area.
Yeah, no, I agree with your thesis that without the structures in place for some of the big asset management organizations to contemplate these issues, and the general push from all investors to make these more material, then it would have been much more difficult for us to be successful, because we certainly needed BlackRock, State Street, and Vanguard, among others, to support our shareholder proposal last year. I would say that despite the amount of rhetoric that has come out of those large institutions over the past 2 years, the actual execution on a voting strategy is not as good as one would hope. And actually, one of the reasons that we launched an index product that with a ticker vote was to honestly just do a better job of executing on shareholder proposals that contemplated environmental and social issues. And so we think there's certainly work to be done in that space, in the shareholder voting space. Not just execution of votes, but transparency. If you went back and looked at our campaign and tried to figure out how Vanguard or State Street voted, you would have a hard time figuring that out, which I think is a curious thing, because they're voting on behalf of so many different shareholders who have entrusted both the capital that's being managed, but also the voice that they're giving up with their shareholder votes, which I think is a forgotten asset, honestly, in the capitalist system. So I kind of answered your question both ways. We needed their support, but they can do better is the conclusion. And we'd like to see it, honestly, over time, I'd like to see our index product become irrelevant, because everybody is as transparent as we are, but we're not there.
Well, what kind of, and maybe that's a question I can bring back, Luigi, in the conversation. What kind of mechanisms do some of these large kind of institutional investors have to try to figure out what are really the preferences of the people that are, that are investing through them? I mean, the issue of like, how does BlackRock know? I'm sure I'm investing money via BlackRock. How do they know, kind of what my preferences are and how I would want them to vote on particular issues? What are we missing there? It looks like there are just huge transaction costs, in the process of getting shareholders to be able to exert their preferences. Luigi, kind of, how do you think about that?
I think actually transaction costs are overstated. I think that until recently, there wasn't very much of a pressure to even try to elicit those preferences. I think now things are changing, and to some extent, I think things are changing precisely because people like David put pressure on BlackRock and company to live up to their lofty rhetoric. And the moment they live up to their lofty rhetoric, they realize that they are a bit in a pickle, because they speak with both sides of their mouth, because they have a bunch of investors who want one thing and a bunch of investors who want another thing. And so, and by the way, they realize that they are too powerful, because at the end of the day, 3 funds can decide with a 25-30% majority in every company in the S&P 500. So I always like to say that I dislike the Soviet economy for many reasons, but one was that power was overly centralized, and the United States is becoming increasingly so that way. And so, but I think the good news is that people like BlackRock and company, they are realizing that they are in the crosshair of this, and that they might be accused of being too powerful. So they're trying to shed their vote to the ultimate investors. So is precisely in this month, they are rolling out a system called voting, where they give institutional investors, not individual investors, but institutional investors, the right to vote the way they want. Another thing that I realized is that the ISS, the one that basically created guidelines on how you vote in various proxies, have some custom-made policies. So there is a Taft-Hartley policy that is basically for labor union. There is a Catholic faith policy for people who have certain religious belief. There is another that is environmental. The only thing they don't have is a straight Friedman policy of the people that don't care about anything else other than money. But I think that there is kind of this variety. So I think the last challenge that we have is how to aggregate the preferences of you and I, Marianne, because I think David is rich and probably very influential, but you and I have our 401k. And so how can people elicit that? And I think there are some interesting economic issue of aggregation of preferences that go back to ours.
Our theorem.
Yeah, but I think that is actually much less difficult than we think. Also, thanks to the internet and thanks to the fact that at the end of the day, preference can be aggregated on a couple of major issues. And so once we know how to grade preferences on those issues, then I think we can do a decent mapping. After all, in spite of the hour and possibility theory, we still believe in democracy. As Churchill said, it's a terrible system, but better than anything else that has been tried. So I think that there might have some form of corporate democracy that might be very imperfect, but probably better than what we have today.
Yeah. No, even, assuming that you're right there, I'm maybe a bit more skeptical because, I think it requires still a lot of attention and paying, people really paying attention to issues and to think carefully. There's also an issue, even let's assume that people have this motivation and want to do, really want to do the right thing. There's always going to be the issue of like information. And then, David, you talked about, developing, describing your framework about trying to collect as much information as possible on the externalities that the companies are posing, environmental, kind of social issues. None of this is, easy to measure, right? So, kind of how do you get, how do you get to that? And, and I would like here to really separate the E, the S, and the G, because my sense is that, kind of when it comes to the E, there's at least hope that, things can be measured. And as shareholders, we can make informed decision. Somebody in the Q&A already wants to talk about the SEC new proposed rule, which will be an extra step in this direction. When it comes to the S side of things, I find things particularly difficult. Kind of. So, what kind of information do you rely on to make kind of the right decision? What's missing? Can you describe this kind of this framework and this kind of information environment for you, David, in terms of making informed proposals?
Yeah, so it's an imperfect system. Let's start there, and we're the first to admit that it's something that we continue to iterate on and are far from a place where we can just close our eyes and have everything we need to make a decision. It's company by company, so we look at each individual company and then dig into the material factors for that business. And on the social side, it's very challenging. The data sets are hard to well, let me just take a step back. We use a bunch of third-party data sets, and we have data scientists on our team that help us both source, verify, and then bring those data sets into the analytical framework that we use on the fundamental side to make investment decisions. So I'll go back to Elizabeth's comment about making better decisions as a third pillar, which is essentially what we're trying to do. But on quantifying the social aspects, the social impact can be very difficult. We've made some headway in the financial system, the financial ecosystem of companies that have actually provided a social benefit to bringing more people into an unbanked system. So fintech companies, for instance, and quantifying the benefit to society and the people that they are able to bring into the financial ecosystem. So we've done some work there. We've done some work on the social side around technology usage that I won't get into too much detail because it's still very early on, and trying to figure out better ways to understand societal benefit and damage associated with that. But it is very hard. To your point, the data sets are very new, and we're still in the phase of almost aggregating those at this point before we can really quantify and point to in any broad way things that we're focused on. On the environmental side, it's easier, but it's still hard work, right? I mean, you're able to quantify carbon footprint for a lot of businesses to the degree you have reporting. But as you just mentioned, the SEC, is pushing for better transparency all the way through Scope 3, and those things are going to require huge lifts from organizations to have the right reporting structures and to get universally accepting accounting standards that we can all rely on. So we're still pretty far off on the environmental side, and then the social side's behind that. And I think that over the next 2 or 3 years, our view is that these data sets, the transparency around the data, the availability of the data, is just going to increase exponentially. And so we have to be ready for that, and build the system in place to digest it, which is what we're doing at EngineOne, so that as it becomes more available, we can verify it and use it. We're ready for it. But an incomplete answer on the social side, because it's incomplete work for us.
What about you, Elizabeth? How do you go ahead?
Yeah. Well, I mean, I heard you, Marianne, talking a little bit more about kind of a retail market. How does Vanguard understand what their, various investors want, or others? I think part of using third-party fund managers is that you're trusting them, you're trusting them to develop a thesis and execute it on your behalf. And so in the same way that we don't, and a fund manager doesn't poll all of its investors about whether a moat is wide enough or how a capital allocation plan looks. I don't think they need to poll all their investors about really things that we know are material economic issues. So climate change is a really strong example of that, but we also know that, in our own industry, the investment industry, women and people of color who can be great assets are routinely and structurally, I won't decide on whether it's purposeful or not, but that there's a lot of talent that we're not taking advantage of. So having a fund manager that's looking in different places for talent that other investors aren't going for or spotting, that has benefit for me. So part of this for me is the evaluation of the fund manager themselves and what they are providing to me as an asset owner. I want them to have a thesis about climate change. I want them to be looking in places other than other investors to find interesting ideas and opportunities. And I don't quite understand the reason why a fund manager needs to check back with all their investors when they're working on things that are really important for performance long-term.
Got it. Luigi, do you want to add something to this issue of measurement?
Yeah, because this is where I think the distinction of whether this is a driving factor of return or long-term return or a consequentialist choice might play a role. Because I agree with Elizabeth that if it amounts to what are the technologies that are going to be more likely to succeed in the future, you want to delegate to the expert to make the decision, and then you invest accordingly.
Yeah.
And that's in corporate America, we have the business judgment rule precisely to protect expertise in exercising their judgment in things that are complicated but very technical. When it comes to more fundamental sort of social choices, I think that that's something that I don't think the managers are particularly knowledgeable of, and you would like to ask the question to investors. So think about getting out of Russia. Probably the majority of people are supporting the right of Ukraine to live as an independent country, and they see as this is a terrible aggression. But how much are they willing to sacrifice on that principle might be different. And I'm not so sure that a manager has not only the knowledge, but the representativeness to make the decision. At the end of the day, I bet money that if the manager is of Ukrainian origin, it feels very different than if of Russian origin. And so why a company should make a decision with the money of the shareholders based on the manager preferences? I think in that case would be interesting to know what the workers think and what the shareholders think and what consumers think. But now consumers is more like a business choice. If your consumers want you out of Russia because otherwise they don't buy the product, that I think is a rational decision any manager can make. And to some extent, even if the workers are going to quit if you keep working in Russia, again, is a business decision. But if the shareholders want to out of Russia in spite of losing some money, I think you have to ask them what they want rather than make them delegate to a manager this decision. That's what, in my view, corporate democracy should be about.
Mm-hmm. Yeah. I'm looking at the time, and I think it's time for me to switch to the questions that have been posed by the audience. So let me start with, there's a couple of them, they're on the same theme. It's not a central theme, but it certainly has come up in the conversation, and it goes back to kind of David's, discussion of like no trade-off, or at least a philosophy that, once we focus on ESG, we will do things that eventually will be good in the long term for the financial bottom line of the company. So some of the audience is really asking, Luigi, kind of, people are talking about Lubosh's work, saying that, ESG is not a good predictor of long-term stock returns. So do you have something to say more generally about this question? Kind of whether by being, kind of socially responsible as a company, ultimately the shareholders are, if they are patient, are not going to hurt the bottom line. And, again, you've talked a lot about, shareholder wealth and shareholder welfare, and the two being different concepts. So I would think that in your mind, these really might be different things, but are you on top of the empirical literature on this question? Whatever I've seen suggests that, yes, if you disinvest from oil and gas and invest in like, the companies that have been screened into the ESG funds, you will do better, but that's because you end up holding a lot of technology and a lot of Facebook and Google. And, kind of that's maybe different, that is not clear, that's a good thing. So Luigi, go ahead.
So Keynes used to say in the long term, we're all dead. And certainly in asset pricing, determining what work in the long term, by the time we figured out, first of all, we're dead, and second, probably the technology has changed. So I would like to believe that's the case, and as with some limitation, it makes sense that this is the case, that sort of if you invest in the technology of the future, you're more likely to survive long term, make more money more term. I think that as a general principle sounds reasonable. I don't think that this is necessarily true all the time. And as an economist, I'm trained to look at trade-offs. So I think that to some extent, if this is the case, my job is finished, because people like David can do their job, and we don't need to think about trade-offs. So that's the reason why I focus on my comparative advantage. And once a trade-off start to arise, how do we resolve it? And I think that the literature so far has been, there is no trade-off, and if there is a trade-off, you have to prefer the maximization of shareholders' value, even if there is an epsilon more. So the way, and people don't like to present in this way, but if you read the literature, especially the legal literature on this, if you are a fund manager and you have to confront it with a choice that you make 2 basis points less this year, but you save, I'm exaggerating, 100 million people that will starve, you have to make the 2 basis points more. You cannot save 100 million people. And I find it not only unpleasant as a human being, I find it wrong as an economist. I think that this entire literature has been distorted by the fact that we think that we maximize returns rather than maximize utility. And yeah, for some people, return and utility are one and the same. For others, they're not. And I think that that's where we should start to educate mostly the lawyers of the difference between utilities and returns.
Maybe there are a bunch of questions that are, targeted at you, and, kind of one that I found interesting was how EngineOne is being perceived by the fossil fuel tobacco kind of companies. Are they kind of viewing you as like an essential threat to their business, or, kind of, an opportunity to pivot towards something that would be, more sustainable? So once you come in and start exerting voices, how are you being perceived by these businesses that you are, trying to change from the inside?
Yeah, I'll stick with the energy and oil and gas because that's really
Yes.
where we're operating. We haven't taken a position to back a tobacco company or engage with one. But in the oil and gas front, I think, when we first launched the company, they did not view us as an existential threat. And in fact, we called Exxon and they didn't know who we were. And so they didn't take us very seriously, which is fine. But we did put together, a very compelling argument, as you all know, that it was rooted in the creation of economic value, right? This was about $200 billion worth of market cap that had been destroyed over a period of time by a management team with no plan to address an inevitable energy transition. And so, relative to its peers, by the way, I mean, the other oil and gas companies globally had already started making these strategic changes, and this was the laggard. And so I think at the end of the campaign, we had kind of made the point that these are economic issues. These are material economic issues for companies to think about. It's not always the case. There are exceptions to every rule, in every instance. But in this case, it is an economic issue, and for many of these oil and gas companies, it's these externalities are economic issues for their business. And so, how are we perceived now? We've been, hopefully, open and transparent with all the management teams that we've been in discussions with across the energy industry as a collaborative partner. I mean, we are looking to point to ways that they can make their business more profitable and more durable as they position themselves for the energy transition. And these are difficult decisions. There are short-term trade-offs for long-term durability. But I do think that if you can find yourself on the right side of the energy transition, that you will be more profitable. I do go back to Luigi's comment about performance and how do we prove that these ESG criteria do matter for companies? In the energy space in particular is an interesting one because it's a cyclical business, and they're enjoying quite a bit of cyclical tailwind at this point, and they've had 5 years of a cyclical headwind. And so you look at performance relative to stock price, which is certainly the outcome that a lot of people pay attention to. But if you go back over a 10-year period and look at the multiple compression that this energy has experienced, because the terminal value of these businesses is not what it was in the 80s and 90s, you're seeing an industry that is under existential threat, and it's reflected in multiples, which are a function of growth rates. And so while you see these cyclical upswing in stock prices, I think whether you have durable multiple expansion or compression is really a good long-term indicator of whether these are real existential threats that will affect the economic outcome of these businesses over time. And we haven't just seen this with things associated with environmental externalities. That is an externality that we've looked at. You can go back and look at the consumer space, big box retailers in particular, when Amazon came onto the scene, right? And the amount of pressure that Amazon put on many of these businesses and compressed the multiples of these businesses, because it too was its own existential threat. And so you boil these down to economic outcomes over time. And I think that while there are always exceptions, that there's a lot of work to be done where they're not.
There's one question, there's a lot of questions. I'm not going to be able to go through all of them. One that I wonder a lot about as well is this issue of, as some of these public companies are getting more and more pressure, whether it is, kind of divestment or kind of shareholders exerting their voices, are we going to see a continued and amplified trend towards more companies kind of staying private? And, and if that's the direction in which we're going, kind of, so what next? Because Elizabeth, do you have views on this?
Yeah, this is something that we've been wrestling with for a long time. 25% of our portfolio is in private equity. So, for example, we have been cooking that in also just the long-term time frame of our private investments. So there's obviously new opportunities in the market as companies stay private longer. So we're seeing different kinds of picking managers with different kinds of strategies to take advantage of that space. But at the same time, we're also thinking about what David's talking about. What are the existential threats to our portfolio when we're locked up with someone for 15 years? So, for example, our real asset allocation is now, you can't get into our real asset allocation unless we're persuaded that 15 years from now, the sustainability factors will be such that we have a chance of making a strong exit. So we're really avoiding, no oil and gas now in our long term. What happens is there's interesting things that come out of all of these choices, right? So our real asset portfolio is not nearly as protective against inflation as you might find in another kind of asset owner that's really trying to have kind of strong, steady payouts every year, like for pensioners. So our real asset portfolio tends to be fund managers that are a little more complicated and opportunistic, and it looks a little bit more like private equity. So it's interesting, you kind of make these shifts based on some thinking about long-term, where you want to be long-term with your money, where do you think you can get your money in and out well, but then you create kind of other considerations that you then need to adapt to in your portfolio. So working in this space is profoundly interesting for asset allocators, because the notion of we're driving towards net zero endowment means, I don't want private exposure to oil and gas, but I'll take it in public for now because it's liquid. I'm going to have to think long and hard about what type of greenhouse gas emissions we want to take, because we'll have a more limited budget for greenhouse gas emissions throughout the portfolio. So we're going to have to make those trade-offs that Luigi's talking about. The trade-offs I'm interested in making, though, are I don't want to have greenhouse gas emissions coming from basically destructive or useless parts of the industry. I want to take greenhouse gas emissions from a General Motors or equivalent that's really figuring out how to make the transition. So there are good places to take greenhouse gas emissions when you're net zero, and then they're kind of a place that you're wasting your budget. And so what I think this is doing is it's asking us to take a more comprehensive long-term look at our private portfolio and think about ESG factors, but not exclusively, right? It's all in the context of building a healthy portfolio 20 years from now for my successor.
David, do you want to add you want to add something to this?
No, I like the way you put it, which is using your greenhouse gas emissions budget wisely, right? In our view, we have a couple of lines we like to use at the organization. The first is, why do people rob banks? That's where the money is, right? Why do people invest in, ag, energy, transportation? That's where the greenhouse gases are, and we have to own these companies and push for transition where we can. And if we can't, then you shouldn't own them, right? But use your budget wisely. The other line that we like to use is people are overly concerned with the amount of greenhouse gas emissions in their portfolio and not the amount of greenhouse gas emissions in the atmosphere, right? Let's focus on what we're really trying to do, which is save the planet, because I'll use my last tagline: there's no business to be done on a dead planet, which is a little bit like Keynes, but that was for Luigi.
And from Darren Walker at the Ford Foundation, many of foundations are managed in perpetuity. Darren Walker said, "What's the purpose of perpetuity if there's no planet?" Right.
If I may add, because I thought it was very intriguing what Elizabeth was saying about having sort of this budget on carbon, and so playing strategically. And if you do it in privately held company, that's perfectly fine. Now imagine that David is doing on a S&P portfolio, okay? So it might mean that you are actually overly reducing gas emission in a company simply because it's cheaper to do it there rather than in another company, which from a portfolio point of view is optimal. From an individual company point of view is not optimal. So can you vote? This is a more legal question, but can you vote? Imagine that you have voting power on both these companies. Can you vote in this way without being sued? Or is it something that you can do?
Yeah, you have to be, it's a great question. From a voting perspective, well, two things. One, there are very few shareholder proposals from a voting perspective that address greenhouse gas emissions. Mostly it's data-driven transparency, like just getting companies to report better on the emissions they have, and accepting the fact that they're going to have to do a better job of reporting 2 and 3 level emissions over time. We haven't been addressed with your question, which is how do you vote one way in a certain instance, but from a portfolio level vote another way. The great thing about our index product is that it is just in fact an index product, right? So we're not overweight any one business relative to the S&P 500 or another, and so we just look at the shareholder proposals and vote in a way that hopefully drives both an economic outcome for the individual business. So that's key to any vote that we make. It can't be ideological, even if we agree with the ideology. It has to be both an economic output and something that benefits, climate or society. So we're looking for there's two checks in that process for us to execute a vote, but we haven't yet hit your issue, Luigi. But it'll probably come. You and I can talk about it offline when it does.
Well, the other thing that's interesting to me about shareholder voting is it isn't actually shareholder democracy, because companies are not required to implement any shareholder proposal that passes in the US. So it's actually not democracy. Shareholder proposals are like customer service surveys. Or, you're looking at your shareholders and asking them what they think about something. And, I don't know any business that, has 45% of their customers say, gosh, this is so important to us as owners of this business, and then you ignore it. So we talk about shareholder democracy, but it's actually kind of a false presentation, because these are not binding, except for places where David's operating like in, vote for directors.
Yeah, the directors.
Except the fact that many institutions, if a vote gets a majority and is not implemented, they don't vote for the directors anymore.
That's a relatively new practice, actually, in the last 7 or 8 years.
But now it's becoming quite important.
Yep.
We're nearly out of time, and there again too many questions for me to be able to do justice to all of them, and I'm sure that we can save them and share them with the panelists after. I'll finish with this one, which I think for me is also a key one, and in one that I don't have a good answer to. And again, maybe David, you might be the best person for this. It's kind of thinking about the multi-stakeholder perspective. So the E, the S, and the G, sometimes what's good for the E may not be as good for the S, right? So, kind of improvements in terms of the environment may mean more jobs being destroyed and, hurting communities. And that's part of the voice, though, that you're trying to exert. And, kind of how do you deal with those conflicts between, again, the S and the G, the S and the E, for example? Yeah,
you guys love trade-offs.
Yeah, we do love trade-offs. Sorry, that's our business. Yeah.
Is this a panel full of economists that want to talk about trade-offs? It's fantastic. It's fine. I was an economics major, so I do enjoy this. There are instances, of course, when making a long-term environmental decision perhaps is going to be detrimental to the business from a workers and wages perspective, right? Because as we talked about, some of these changes require investment. They're inflationary. I mean, if you ask companies to internalize the externalities, the cost of everything goes up, and so the short-term trade-off is very real. The question then becomes, can you make, go back to our point, can you make an economic argument for the long term, right? Can you say over time that this will benefit the shareholders and the stakeholders from an economic perspective over the long term? Now, there will always be, with change, there are marginal negative outcomes. There's no way around that. There is no perfect answer. So there may be job loss for inflationary changes or strategic changes. But I guess the other question is, if you don't make those changes, what are the outcomes, right? You may preserve 100 jobs, but you do a tremendous amount of environmental damage over time. And then our argument is that environmental damage will come to the forefront of the business. The business will shut down, and then you don't lose 100 jobs, you lose 10,000 jobs. And so, I think as long as you as economists root your argument and your decision making in what increases long-term profitability and durability, you do optimize your outcome. But maybe I'm an idealist.
Great. Well, we're out of time. I'm just going to thank everybody. Thanks, Elizabeth. Thanks, David. Thanks, Luigi, for being part of this 1 hour panel. And hopefully there'll be more chances to talk again about these important issues. Have a good afternoon, everybody. Thank you.